In the year 2000, Enron stood at the top of the corporate world. It was named America's most innovative company 6 years in a row. Its stock price was soaring. Its executives were treated like celebrities, and its headquarters in Houston rose 50 stories into the sky, a monument to modern capitalism. Employees believed they were getting rich. Investors believed they were safe. Politicians believed Enron was proof that free markets worked. But behind the glass towers and the glowing earnings reports, Enron was already collapsing. By the end of 2001, the company would fall so completely that even its own board of directors claimed they did not understand what had happened. And here is the terrifying part. Enron did not fail because of a bad economy. It did not fail because of a single mistake. It failed because it learned how to turn accounting into a weapon, a way to make massive losses look like record-breaking profits. Tonight, you're going to see how Enron became the smartest guys in the room, how it reshaped markets to serve itself, how it engineered shortages for profit, and how its collapse destroyed tens of thousands of lives while the people at the top walked away with millions. Enron began as a very ordinary company. In 1985, it was created by merging two natural gas pipeline businesses, pipes in the ground, gas flowing through them, steady and predictable. Then came a man named Jeffrey Skilling. Skilling was a former McKinsey consultant with a belief that energy should not be sold like a utility. It should be traded like stocks. Gas today, gas tomorrow. Contracts bought and sold like gold. Under his vision, Enron transformed from a pipeline company into a trading floor. Instead of making money from energy itself, Enron made money from promises about energy. They stopped selling power. They started selling predictions. Skilling also introduced a brutal internal system called rank and yank. Every year, the bottom 15% of employees were fired, no matter what. It created a culture where survival mattered more than truth, where bold risk-taking was rewarded, and quiet warnings were punished. By the late 1990s, Enron was no longer just trading gas. It was trading electricity, internet bandwidth, weather futures, water rights. If something could be turned into a market, Enron tried to own it. Wall Street loved the story. Enron stock exploded upward. Analysts praised its innovation. Magazine covers followed. But behind the success, many of these new businesses were losing enormous amounts of money. So the question became simple. How did a company losing cash look wildly profitable? The answer was accounting. Enron used a system called mark-to-market accounting. Here is what that means in plain language. If Enron signed a long-term contract that might earn $100 million over 20 years, it recorded the entire $100 million as profit the moment the contract was signed, not after the money arrived, not after customers paid, immediately, even if the deal later failed. So Enron could take a risky bet, book a huge profit, and worry about the loss later. And when a deal went bad, they did not admit it, they hid it. Which raises a dangerous question. Where do you hide billions of dollars in losses? To understand what came next, you have to look at what Enron did to California. In 2000, Enron entered California's newly deregulated electricity market. They quickly discovered something unsettling. If they could create artificial shortages, electricity prices would skyrocket. So they did. Enron traders used code names like Fat Boy and Death Star. They persuaded power plants to shut down for maintenance during heat waves. They rerouted electricity out of state and sold it back at higher prices. The result was chaos. Rolling blackouts swept across California. Traffic lights went dark. People were trapped in elevators. Homes lost air conditioning during extreme heat. And inside Enron's trading room, the reaction was celebration. Recordings later revealed traders laughing as they discussed the crisis. To them, it was not a disaster. It was an opportunity. California paid billions more for electricity, not because power was scarce, but because scarcity had been engineered. It was not innovation. It was exploitation. And while Enron was manipulating markets, its own finances were quietly collapsing. To hide those losses, Enron built a maze of secret partnerships. They had names like LJM, Chuco, and Raptor. These were called special purpose entities. Here was the trick. Enron would sell its failing assets to these partnerships. On paper, it looked like Enron had made a profit, but in reality, Enron secretly controlled the partnerships. It was moving money from one pocket to the other and calling it success. Even worse, Enron's own chief financial officer, Andy Fastow, was running many of these partnerships himself. He collected tens of millions of dollars in management fees while the company sank. It was a conflict of interest so severe that it should have ended the scheme instantly. But no one wanted to stop it because Enron's stock kept rising, and as long as the stock rose, the illusion held. Which leads to the most dangerous question of all: what happens when the stock price stops rising? In early 2001, the cracks began to show. A financial reporter named Bethany McLean published a simple article asking one question: how does Enron actually make money? No one could give her a clear answer. Then, during an analyst call, a hedge fund manager asked Jeffrey Skilling for a balance sheet. Skilling responded by insulting him on a recorded line. The mask was slipping. Inside the company, a vice president named Sharon Watkins uncovered the truth about the hidden partnerships. She wrote a letter to CEO Ken Lay, warning that Enron could implode in a wave of accounting scandals. Ken Lay did not go public. He told employees everything was fine. He encouraged them to buy more Enron stock. At the same time, executives quietly sold their own shares. Millions of dollars flowed out of the company from the top. Then the stock began to fall. And when it fell, the hidden partnerships collapsed. All the debt that had been hidden rushed back onto Enron's books at once. Billions of dollars appeared overnight. Credit rating agencies downgraded Enron's debt. Banks pulled their support. Investors panicked. But the worst victims were not the executives. They were the employees. As Enron's stock crashed, workers tried to sell their retirement shares. They could not. Their accounts were locked due to an internal administrative change. Executives could sell. Workers could not. People watched their life savings evaporate in real time. Retirement funds of hundreds of thousands of dollars became almost worthless. Some lost their homes. Some lost their marriages. Some lost their trust in the system forever. In October 2001, the Securities and Exchange Commission opened an investigation. By then, Enron's accounting firm, Arthur Andersen, knew what was coming. Instead of reporting the fraud, employees began destroying documents. Truckloads of paper were shredded. Computer files were deleted. They were trying to erase the story. It did not work. On December 2, 2001, Enron declared bankruptcy. At the time, it was the largest corporate collapse in American history. 20,000 employees lost their jobs. Over $1 billion in retirement savings disappeared. $74 billion in investor wealth was wiped out. Jeffrey Skilling was eventually sentenced to prison. Andy Fastow went to jail. Arthur Andersen collapsed as a firm. But the deeper lesson went far beyond Enron. Enron did not invent greed. It perfected deception. It proved that a company could be too complex to understand, too profitable to question, too powerful to challenge, and still be hollow. New laws were passed to prevent another Enron. Sarbanes-Oxley tightened financial controls. But history did not stop. The housing collapse. Lehman Brothers, FTX. The tools change, the language changes, but the pattern remains. Complex systems, hidden risks, blind trust. Which leaves one final question. If a Fortune 500 company could fool Wall Street regulators and its own workers for nearly a decade, how do you know the next Enron is not already sitting in your portfolio, waiting